Welcome to a summary of our shipping quarterly. First of all, we hear words like multi-year high and record high a lot these days, describing the market. Could you please explain what's going on?
It seems like a perfect storm, at least in oil tankers at the moment. So you have U.S. sanctions on Chinese fleet. You have oil traders are wary of taking Venezuela trade vessels. You also have the attacks on the tankers in the Middle East. And now last week we also had the typhoon in the Far East. So this seems to be coming together like a perfect storm, and the VLCCs rose to $300,000 a day on Friday. Although a lot of this is the risk premium, it's also important to note that the underlying fundamentals are really good as well. The same risk premiums are also impacting the LPG shipping space. But we also see spot rates there impacted by strong U.S. exports. So it's also multi-year highs in the LPG space. For LNG, we see a vessel starting to move, or the spot rate starting to move. We do see similar patterns as we saw last year, where rates reached all-time high during the fourth quarter. We have a thinning tonnage list in both basins, and we also see more congestion around discharge and vessels being used as floating storage. For dry bulk, there has been strong earnings in the third quarter after a lackluster start to the year. We now have scrubber retrofitting, which is taking out some of the fleet, and we also have normalization of Brazilian iron ore exports, which is supporting the market.
Okay, so looking further ahead, how do you see the future of shipping?
I think in the near term, the risk premium on oil tankers will subside. It's hard to kind of put a number on or a timing on when, but we do have a forecast for the fourth quarter 19 of $100,000 a day. So that's down from 300,000 today, but it's still significantly higher than our previous forecast from July of 81,000 peaks. For dry bulk, or I also would like to mention on oil tankers that for 2020, we still see strong demand growth from IMO 2020. There's a myriad of implications from the sulfur regulations coming in from January. And we also see U.S. exports supporting the market. And against all that, we have the lowest order book since February 1997. So all stars are seemingly aligning for oil tankers. On dry bulk, I think fourth quarter will be supported by iron ore exports out of Brazil and scrubber retrofitting. But I'm a bit concerned about the coal imports into China. If they impose the same restriction as last year, as they capped the import levels on 2017 levels, we estimate a significant drop in imports for the last quarter. So all in all, we forecast a flat market for dry bulk in the fourth quarter. Looking further ahead, 2020 seems like a sluggish year for dry bulk. There's not that much supply growth, but we think demand growth will be even lower. But that takes us into 2021 and 2022, when we see the expansionary phase of the cycle really taking off again. So I think any weakness in dry bulk shares in 2020 could be an opportunity to buy ahead of further consecutive improvements. For LNG carriers, I think the fourth quarter should be strong, as mentioned. But we do think that fourth quarter 2020 could mark the peak, as demand growth in 2021 does not look that massive against a rather large increase in supply of LNG vessels. For LPG shipping, U.S. exports again, U.S. hydrocarbons are driving a lot of these markets. Exports are really continuously growing. And it seems like the story is going on for the next few years as well, with increasing earnings each year.
Okay, so against that backdrop, what's your expectations for share prices, and what advice do you have to the investors?
I think at the moment we see kind of a disconnection between asset prices and earnings. So the first thing I would expect is that asset prices will increase. This is especially for oil tankers and dry bulk. And share prices tend to be highly correlated with asset prices. So that should potentially push share prices further up, in my mind. So, for instance, when you do the calculations, we see on a 1 to 2 year basis, we see a 60% upside in dry bulk, 85% in oil tanker, and 46% in LNG, and also 60% in our covered VLGC universe. So that's significant. And when we kind of in the report do the portfolio allocation to maximize return, we do allocate 42% to oil tank, 28% to VLGCs, 18% to dry bulk, and then 12% to LNG carriers.
Okay, so more specifically, can you give us 3 top picks?
Yes. I would recommend or have an extra look at ADS crude carriers. We have 90% upside. It's quite, it's a vintage tonnage, so the highest elasticity on asset prices is on the older vessels. And also TK tankers, where we have 120% upside to our target. So again, highly leveraged operationally and financially. And looking at the VLGCs, I would recommend Avance Gas, where we have 88% upside to our target. So even though a lot of these shares have moved quite a lot, I still think there's significant upside in many of them.
Okay, thank you. So before we wrap up, do you have any final remarks?
I think, as a final remark, I would say that being an analyst, speaking to investors, I noticed over the past few years that shipping has basically been, I would say, sector non grata amongst most investment committees, and that is still going on. So there's been an underinvestment in shipping now for many years, and I think that underinvestment, besides LNG carriers, that's important to notice. But that underinvestment in oil tankers, dry bulk, and LPG shipping should lay the foundation for one of the best expansionary cycles in many years.
Oh, thank you for that summary, Joakim. And if you would like to read the full report, it's available for free at cleaves.no. Thank you for watching.